Dave is about cost segregation, and Joseph is your neighbor, right? About cost, because he owns a couple of commercial buildings, about cost segregation.
Yep. I got one of
We want to give him the information.
Absolutely. I can link you up with it. You know, just find him on LinkedIn. This guy's everywhere. Yona Weiss. I mean, he's
Yona. Yeah.
he's the man.
That's another one. Yeah.
As long as you have over $1 million, like if it's a big enough deal, it's worth it. But he'll run you through it. I had him on the podcast. We're gonna have him on the show on here also.
We have Carlos here. What's up, Carlos?
Hey, how are you?
Hey, man.
Great. All right. So let's start this. Nico, can you introduce our guest today?
All right, guys. Yes, absolutely. So welcome back from the breakout room. I hope you guys found some value and some connections. Today we got David Frasz. He's a direct lender. He's going to help us explain to us what that is, because I'm not 100% sure, of non-recourse Fannie Mae, Freddie Mac, FHA, HUD loans, and bridge financing for multifamily properties nationwide. Guys, he's passionate, strategic, and entrepreneurial commercial real estate professional with deep industry knowledge and leadership experience, who consistently delivers value through integrity, attention to detail, and building lasting relationships. And there are some people on this call, or people that we know, that have worked directly with him and that can attest to his character and work ethic. Mr. David, welcome to the Multifamily Investors Network.
Thanks, Nico. Yeah, I appreciate you guys having me on, and I actually think the group, it looks like, I can see everyone. It's not too big, so I hope I can get everyone's questions answered and make sure that I get an opportunity to chat with everyone. But I think this is a great format, and I appreciate you guys putting it together and having me on.
All right, thank you for being here, David. So I think I could start with giving you this question. So tell us, like, what is the role of lender in multifamily investing?
Yeah, so I think a lot of times folks that may be confused about the answer to that question, they don't know sometimes with who they're working with is a broker or a lender, or what part of the industry that person is exactly. And so that's kind of a funny question to ask somebody, but it's a question that I'm happy to get. The role, if you think of residential lending, it may be the same thing. You might work with a broker, you might work with a lender. It might be a non-bank lender or a bank lender like Citizens Bank or TD Bank or whatever. It's sort of the same in the commercial space. There are lots of different types of lenders. There are banks, there are private money lenders. There are institutional lenders like us that are direct lenders. So my role with the lender is as a point person. That you can call us an originator, call us a lender, call us a banker, relationship manager, a lot of different names for what you could call me. But the primary role is to help obviously bring business into the company. But when it comes to my relationship with the client, it's really about that. At least for me, it's about the relationship and making sure that I'm guiding you and guiding the loan, the transaction through the process in a smooth fashion to get you guys what you want.
Right. So I personally think lender is also one of our partners, the critical partners, because no one really, but when it comes to like the multifamily, because we're all into multifamily, like we don't really pay everything in cash, right? This is a lot. So we always, most likely we're going to have a lender as our partner together. So in that sense, I think it's the lender, I see them as a critical partner members of the team.
Yeah. I mean, 80% of your capital stack, right? I mean,
oh yeah,
sometimes more. If you're doing a bridge deal, you could be 80, 83, 85, 87, 90% of your capital stack. I think a lot of investors focus a lot on equity. And that's I think you guys, if depending on how long you've been on the GP side, you probably realize that it becomes a point where the equity comes pretty easily, but you still have to go out and find the debt on every deal, and it's 80% of the stack, so it's important.
Right. So what types of loans are there? Like I hear a lot about is a stabilized loan or a breach loan. Can you go a little details on that?
Yeah. So I mean there are degrees in both stabilized and bridge. I mean, I'm looking at a bridge deal right now that's 100% occupied, but they won't even get 70% on in-place cash flow. They won't even get 70% LTV on in-place cash flow. There are deals that are quote unquote stabilized, but they're 85% occupied, and they've got another 10% in collection loss. So they're really only collecting 75% of what they should be. But from a lender's perspective, or from an investor's perspective, the primary difference between conventional stabilized financing and bridge financing, which is a huge category that encompasses, our bridge financing at fairly low rates from an institutional lender, all the way to hard money lending at 14-15% interest. But the primary difference between stabilized financing and bridge financing is if there's a need for a transition, whether it be the rents are, half of what they should be. They're $500, but they should be $1,000, and you're going to have to get some sort of financing that's going to give you credit for the fact that the rent should be $1,000. As a lender, a conventional lender, particularly with Fannie Mae and Freddie Mac, we're underwriting exclusively to in-place cash flow. So if your rents are $500 and they should be $1,000, you're probably, paying the seller some amount for the value that you're going to force out of that property. So you might be paying for $750 rent, but the rents are only $500. So you're not going to get a loan from us that gives you credit for that. So that's kind of where you would use a bridge financing, where they take a little bit of a higher interest rate, sometimes a lot higher interest rate for the risk that they're taking, knowing that the current rents aren't satisfying, the debt or, the loan to value.
Oh, Nico, you gotta unmute.
Sorry. Do people typically, I guess, refi out of those?
Yeah, always. I mean, almost always. I mean, I don't know that I've heard of an instance where someone's just continued to roll from one bridge loan to the next. But I mean, bridge loans, again, they come in a lot of different shapes and sizes, so to speak. I've seen borrowers do bridge loans literally for a period of 2 to 3 months, just because they needed to close. They may have a big money partner and they closed in cash in 2 weeks, and they needed 2.5 months to get conventional financing. I've seen people go into bridge deals on 300-400 unit properties, and 3 years later, they're still in the bridge loan. So it really depends on how long you're in the loan, but there's always, that's the primary analysis that a bridge lender will do on the deal, is what is the exit, because that money is balance sheet money in almost all cases, and they need to make sure that they get that back.
Okay. I do see there's someone, they're brokers, right? But you're not brokers, right?
I'm not a broker. I'm a lender. That's kind of what I was alluding to earlier. There are a lot of brokers out there that will introduce themselves as a lender. They'll say, "Hey, Ryan, I'm Nico's lender," but they're actually a broker. They don't give you the money. They don't take risk on the money that's been put out on the market. They are basically a transactional piece of the puzzle. that in some instances they're invaluable, and they, you know, do a lot of work, and they help clients get deals that they wouldn't be able to get because, you know, they might be finding you a lender, just like in this bridge situation. They might be finding you a lender that can close you a deal on a $10 million property in 2 weeks. And that's not something I can do. So in that sort of instance, if you were to come to me and say, Dave, I need 10 million bucks in 2 weeks, I'm not going to be the guy that can help you with that.
Okay. So what would be the pros of going directly to the direct lender instead of going through brokers? Yeah,
I mean, there are actually quite a few of them. Again, in instances, you know, where you've got a loan or you've got a deal and you're not sure what type of financing is going to work. Maybe it's right on the cusp. Maybe it's 85% occupied. You probably, you know, maybe it's 84% occupied. You'd like to get it to 85 or 90 so you can get Fannie or Freddie financing, but you're not sure it's going to get there because the seller's in control of the deal and they don't seem interested. So you might need bridge financing or bank financing, and someone like myself doesn't have all those relationships. In an instance like that, a broker is going to be able to get you where you need to be. They're going to have relationships with community banks, credit unions, private money lenders. They're going to have a lot of different options that can kind of create a web of safety for you so that you can still execute that deal. But you know, let's just say it's a 90% occupied or 95% occupied deal. You're going to force, you know, 10, 15% on the rents. You're going to, you know, drive the cap rate down a little bit, and you're going to invest with partners and make it a good deal. You pretty much know that it's already a stabilized property, and you're going to get financing from whether it's me or a bank or whoever. The working directly with a lender in that instance is going to make the communication a lot clearer. Just think of if you're working with a broker and your broker brings you to me to do a loan, you have to go to your broker and say, I want a 10-year fixed rate loan. Your broker comes to me and says, the client wants a 10-year fixed rate loan. I say, okay, here's the rate on a 10-year fixed rate loan. He goes back to you, says, here's the rate on a 10-year fixed rate loan, right? So there's a lot of back and forth, and what that does on very simple deals, it's not too much of a problem. But on deals that get really complex, on deals that have a lot of what we would call hair on them, that require waivers, that require a lot of digging into, you know, sponsorship history, whether there have been any credit blemishes or anything like that. I mean, there are a million different reasons that a deal could require extra attention. But when you run into a situation like that, the communication is huge. And if one thing gets missed on the front end, and a deal gets, you know, because the question wasn't asked or it wasn't answered properly, you know, if you're working with a broker, sometimes they just say, yeah, you know, they meet that requirement. Don't worry about it. And then if we find out 3 weeks later that you don't meet that requirement, you could go from getting a loan of 20 million and having $1 million hard into the deal to all of a sudden not knowing that you're going to be able to get financing. So communication, quote accuracy, again, we're the ones putting the money out. We're the ones who are underwriting the deal, screening the deal, getting the approvals that are required. The brokers don't have control. And again, if the information is not tossed back and forth properly, they're not going to have the same accuracy on a quote. It really comes down to being able to ask all the important questions. And with that, lenders, I mean, we're on calls every week with Fannie and Freddie. We're on calls every week with our credit team, with our kind of senior management team. So if something changes in the winds with the lending environment, we're the first ones to know. So that sort of delay in information can make a big difference maybe not so much if you have, 75 days in your contract, but, if you do a 45-day contract on a super competitive deal where you put $500,000 down day one, you need to make sure that everything is moving really smoothly. And that's kind of where working directly can really help in that respect.
Great.
Yeah, that clears up a lot for me, man. And can you, like, so how do you get paid versus how does a broker get paid? And then we got some questions in the chat box, which I'll get to in a second, but maybe this will help clarify Bobby's question.
Yeah. So, I mean, it's different, but it's sort of the same. With a broker, you're almost always going to pay an origination fee is what you'll see it called. They might call it a broker fee. They might call it a placement fee, number of different ways. But essentially that's you paying. We get paid too as the lender, and I get paid by my company. But basically it's either somehow in the rate or it's charged as an origination fee up front. At the end of the day, how that gets sliced up, you may pay, a large brokerage company a 1% origination fee. And then, the broker that you are working with gets, some piece of that. At the end of the day, the money is going either to the lender or to the broker. And one important point there is that as a lender, we are dictated by Fannie Mae and Freddie Mac a minimum amount that we have to charge. And so when a broker is involved in the deal, it's not that they're getting paid what we would get paid. Both people are getting paid. So that's the important distinction. And that's why I say brokers can add a ton of value, helping you guys to put deals together and get deals done. But if you already know what type of financing you're going to get, you really need to evaluate how much that, middleman is worth, because when you add another cook to the kitchen, you pay another cook.
Huh. So would it be fair to say then that because you have a broker, you might end up paying a little more than what you're supposed to pay to directly when you directly deal with lenders?
I would be, obviously I don't have data on this, but I would be fairly safe in saying that when you use a broker, 99% of the time you're going to pay more in total than you would if you went directly to the lender.
Right. Yeah, it makes sense. I mean, you're just getting a middleman in there. But so if you have a stabilized property, 90% occupied, you're ready to rock, just go direct to lender. I mean, if you're having trouble getting something financed, find a broker, they can help you out. It's basically the rundown of what you're saying, right?
Yeah, again, brokers add a lot of value. They're the market. The industry couldn't work without them. For example, this is a perfect example, right? We're living through a period where we just are coming out of a highly uncertain period of time where for us, not only did we in April and May and June get business that was previously locked up with banks, but there are other lenders that got business that was previously locked up with us that we couldn't do. Because when the winds change, as a lender, I'm kind of stuck. If Fannie comes to us in March of 2020 and says, no, we're only doing 70% loan to value. If you need 80%, if you've only raised enough equity to put down 20 or 25%, and you need 75 or 80%, I'm not an option for you anymore. You add in a debt service reserve, you add in, other escrows or anything like that, I'm not necessarily an option for you anymore. So in an instance like that, you may know what you want in terms of financing, but there's still something that, it could still fall through. And so in an instance like that, I say, if you're going direct to a lender, just make sure you've got a good relationship with them. And someone like myself, I'll tell you when the winds change and I'm not going to be able to finance your deal, or something like that. And in that instance, I would say you might go look for a mortgage broker who can, shoot this out to 100 people, and see what sticks.
Okay.
The other thing I would say on that as well, because in the breakout session, and I just know some of you guys are syndicating deals, I think it's important, as both a lender and an investor myself, I think it's important for syndicators to recognize that they have to be good stewards of the equity that they're raising from their investors. And again, in some instances, that means paying a broker to get the 80% instead of the 70%, or find a bridge financing that allows you to execute on the transaction. And other times that means doing a little bit of additional work yourself by working directly with a lender, which means you're not going to have someone else necessarily filling out all your paperwork for you, but you're saving the deal and you're saving your investors money. So I think it's important to think of it, if you were a limited partner, and you were signing on to a deal with a GP who was using a buyer's broker, using a mortgage broker, and also charging a 2% acquisition fee, and also charging a 2% asset management fee. But that's 6% right there. And you kind of wonder, you're getting paid all this money, but it seems like you're just farming out all the work. So I just think that that's an important consideration when you think about each deal. Are we going to use a broker on this deal? Are we going to go direct? What type of financing is going to work best on this? Early on, it's harder to do that. And I think that's why a lot of newer GPs start using, mortgage brokers as kind of a one-stop shop. But as you get more deals under your belt and you get more people's money, that you're stewards of, I think it's important to think about which way you're guiding the money.
Okay, great. Thank you. I see everyone here is kind of players in the game already. So I see that the questions are being more specific. So instead of going through more general questions, why don't we just unmute and then just ask a question? So we could start from Joe.
Hey guys.
Hey Joe.
Hey David. Hey, so my question is about supplemental loans.
Yeah.
Do you have experience with supplemental loans?
Yeah.
So what are you looking for as far as like requirements for LTV on a supplemental loan?
So the supplemental loan is generally going to be, think of it like you topping up your glass of water, right? You're not going to go any fuller than you had it initially. It's more so when the deal's amortized down or the value's been added, and so the effective loan to value of the existing note is lower. You want to get obviously the debt back up so that you lever the deal again. So generally you're going to be held on a supplemental. You're going to be held to the standard kind of refinance level. So, if you're 75% LTV on a refi, you'd be held to a maximum LTV of 75% on both notes.
Okay. So I'll give you an example. So we're not under contract, but we are close to under contract. It's going to be a loan assumption.
Mm-hmm.
And then there's going to be quite a bit of equity in the deal.
Mm-hmm.
So we're looking at doing a supplemental loan. um, could we do that simultaneously?
Yep.
Or, okay, so as soon as we close it, we could take out a supplemental, or
You can do it. I mean, I don't know. It sounds like you're inking the contract soon.
yes,
Yeah.
hopefully this week.
Okay. Well, good luck. But I think, yeah, I mean, basically you could do what's called an assumption supplemental, which you do the assumption and you do the supplemental at the same time. So basically when you close your acquisition, you have two notes right out of the gate.
Okay.
So you don't need to wait unless you want to wait, unless you're going to add value and you want to capitalize on some of that.
Great. I have another follow-up question on a loan assumption. We're seeing a lot more loan assumptions.
Yep.
So what are lenders looking for, going from one, from the seller to the buyer, as far as strength as a buyer? What are you guys looking for?
Yeah, that's a really good question. I get that question all the time. So the numbers side of it is pretty much the same. You loan to value, debt service coverage, the underwriting is the same. You underwrite reserves and management and all of that. Certainly as an assumption, if the seller has a 5% management fee and you're coming in with a 4% management fee, that gets incorporated into the underwriting, of course. But when it comes to the sponsorship group, the major thing to remember is the lender still maintains the risk on that note, no matter who has it. So think of it yourself. If you've got a tenant who has an 800 credit score and they've signed a 12-month lease, and 2 months in, they want to move out, and someone else with a 600 credit score, they want to replace themselves with someone with a 600 credit score, how likely are you to give that person the keys to that unit? Probably not very likely, because you've already locked in somebody for 12 months who's a prime credit tenant. It's the same thing from our perspective. The credit folks on our team or at any lender are going to say, who are we replacing this sponsorship group with? And so that's why if you've got an institutional sponsor who's got 20,000 units and you're coming in with 15 units to your name, and you've got a partner who maybe owns a duplex, and you guys are going to come in and try to take over a $10 million loan, it's not going to happen.
All right. Thanks, David.
Sure.
Lam, you had a question. You want to ask that question yourself, Lam?
Yeah. Hey guys. How you doing?
Doing well, Lam. I'm just wondering why you keep staring at me.
Sorry, I'm as I told the guys earlier, I'm multitasking, so I'm trying to do something.
No problem. I was just making a joke.
Oh yeah. So I was just wondering, because you know about the COVID-19 reserve
Yeah, I know it well.
Yeah. There's from your company as a lender, do you have this similar strict reserve requirements? You know how it was like originally it was like 18 months of P&I. Well, I believe it was Fannie, and then Freddie was like a little bit more lenient. It was like 12 months. And I think since like a month or two out from the original restrictions, they kind of loosened their straps a little bit, and it went down to like 6 months. So what at this point, what are your requirements in terms of reserve requirements?
Again, those requirements.
David, before that, I just want to make it a little more general question, because some people might not know what's going on with the reserve requirements from the beginning. So can you include that?
Yeah, sure. No, I mean, it's a good question. I mean, this has been I mean, we've dealt as lenders, we've dealt with this every single day since March. Questions like this coming from everyone on every single deal. The reality is these reserve requirements, at least from where I sit as an agency lender, as a Fannie Freddie lender, the requirements aren't coming from us. They're coming from Fannie and Freddie. So, so they are the same requirements across every Fannie and Freddie lender. The 6 months versus 12 months versus 18 months, that's obviously a 6, 12, or 18 months of your P&I. So not interest only. So if you're going to get 5 years of interest only on a loan, we're still taking the reserve escrow on your P&I payments. So depending on the size of the deal, it can be quite a large number. But there has been more leniency on that lately, but not as far as a guide level kind of change, more so in the sense that they're allowing us to apply for waivers on particular deals. So for example, if you're wanting to do a deal at 65% loan to value, I just closed a deal recently in Texas in the Longview market, and they took a 55% loan to value deal. They did not cash out. They refied their existing note and paid for their costs, and brought a couple bucks to the table for closing. But they were not required to fund that reserve on that deal. So the agencies have been a little bit more flexible with that. It's not just 55% anymore. You can get a little bit of flexibility, but in general, it's deal by deal. So I couldn't sit here and tell you that, if you do a 55% loan to value deal with me in whatever market you call home, I couldn't guarantee you that they would waive it.
Okay, so David, essentially you are a DUS lender, is that correct?
That's correct.
And your requirements fall in line with what the Fannie or Freddie or the agency loan requires.
That's correct. Yeah, I mean, I think that hits on another point that I get a lot, questions just like that. I think there's some I don't know who's kind of putting this out there, but I think there is some confusion as to the differences between agency lenders. And for the most part, most of what we do, whether it's pricing, debt service reserve, any of our requirements are all dictated by Fannie and Freddie. So there's not too much flexibility. The most important thing, the most important difference between lenders is obviously the relationship you have with the lender, me or one of my counterparts. So the relationship you have and also the expertise and experience they have when it comes to underwriting deals, because the underwriting is the only real area where we can get creative with deals.
Thank you so much, Dave.
Sure.
Awesome, man. I'm going to follow up that underwriting question after this next question. So James has a question. Can you please explain when and under what circumstances will those funds be released?
Yeah, so it's a little bit different for Fannie and Freddie, but essentially they're held for a period of time. On the Freddie Mac side, most of the time they're going to be held for 12 months, and then you request that they be returned to you, and you provide your rent roll, your occupancy, and your collections. And as long as you meet the designated requirements in the commitment, which is basically that you're able to service your debt service. If the loan is underwritten at a 125 debt service coverage, if you're at a 125 debt service coverage 12 months from now, and your occupancy is 90% or 95 or 85 or whatever, you're going to get your money back. Fannie, it's a little bit different, but it's essentially the same thing. You just need to make sure the property's performing. So the whole purpose of the reserve is to protect against default in missed payments and that sort of thing. That's why it's called a debt service reserve. So as long as your property's operating where it should be, you're going to get your money back. But it will be held for a period of time. So I think with Freddie, it's 12 months. And for Fannie, I think it's a minimum of, I think they do it weird. It's 2 consecutive quarters. It's 6 months and then 2 consecutive quarters. So of operating at that level. So if you have a dip, it resets and you have to go another 2 quarters. But essentially it's the minimum I think that you would have your money held with Fannie would be, I believe, 6 months at the very minimum.
Ryan, did you have a question?
I've got a few. So I'll start with this. David, do you have, let's say, a home run type of deal that when something comes into your inbox or across your desk, you're like, wow, this is perfect. This is going to close no problem. Or is it just more of a case-by-case basis, not really applicable?
Oh, it's always case by case. But yeah, I mean, I can paint a general picture for you of something where, I mean, everything is going to work, right? So let's say it's a $5 million deal. You're buying it for whatever, $7 million. No, let's do this. You're buying a property for $10 million. You've got 1031 money. You've done everything by the book on the 1031 side. You only want $5 million for the loan. So it's a 50% LTV loan. Your partners, whoever, have credit that's greater than 680. You got $10 million in the bank. You got $2 million liquid in addition to your 1031 funds. You have 500 units in your REO. You live within 100 miles of the property. You're hiring a third-party manager that has deep experience in the market. The underwriting is obviously, again, 50% loan to value, probably operating at a 170 debt cover. And there are no title issues. Your organization structure is pretty straightforward. It might be you, your partner own 50-50, and you want to do a 10, 12, 15, 30-year note. You don't care about interest only. And at the end of the day, I mean, there's not too much more than that. I mean, if the underwriting checks out and the sponsorship checks out, and the legal background stuff checks out, there's really nothing else to it. I guess the one thing I didn't mention there is there could be an environmental condition on the property, but that's kind of the thing that comes out of left field sometimes. But most of the time, you guys would have already vetted that up front with the broker.
Or do you guys run an environmental study during due diligence?
We will. And that's I'm glad you mentioned that, because let me make something else clear too. So a lot of times I get deals where the borrowers have already ordered an appraisal, or they've already ordered an engineering inspection. And if you get us involved early enough, depending on what the situation is and how much hard money you have to put down and when you have to put it down. But if we get a deal going early enough, such that we can go under application and get our appraisal and our engineering and our environmental reports ordered, within a day or two of executing the PSA, then we can get you those reports, at least get you the findings of those reports within 2.5 weeks. And as long as that's before your go hard date or your date, the no return date, then you don't need to order those additional reports. And I see that sometimes, and it's kind of obviously wasteful to get an appraisal just to go in and get another appraisal.
Now, do some people, just touching on that appraisal and the environmental study, is it possible to hire somebody? Let's say you start late with the lender. Can you use 2 reports that you've done yourself personally and submit those to you guys, and you guys accept those, or generally not?
Generally not. They would have had to have been done by approved Fannie Freddie vendors, which is not all vendors. And they would need to have been done to Fannie and Freddie standards. Sometimes we'll have deals that for one reason or another fell out from another lender for, I don't know, some reason, pricing, disagreement, working with a broker. They decided not to work with a broker. They wanted to go with us. They got the reports. They said they're already done for Fannie Mae. We just want them reassigned to you. Usually it's, pay $500 or $1,000 and they, reassign the report, and we have what's called a peer review. We'll have another engineer, another appraiser, just peer review it to make sure that they did do what they were supposed to do. And then we'll use the reports. But for the most part, we have to get new reports. A lot of times community banks and credit unions can take, they can take basically anything that tells them what the value is. But they can, they'll use appraisals that have already been done from the lenders. That happens a lot with us because our lenders our appraisers and engineers are kind of at the top of the ladder that, these other banks, if a deal falls out from us, you can take our appraisal and you'll most likely be able to get it used by whatever other lender you use.
Okay. All right. Thanks. Next question, kind of on the opposite end. Let's say a group of operators, less than 500 or maybe 1,000 units. What's the top reason you see a loan not being approved or not getting funding? Do you see something that commonly happens?
And sorry, you said they have 500 or 1,000 units?
Yeah, let's say, kind of starting out between, 3-4 guys, the total is maybe 500 units tops. What are some items to look out for, to avoid, or something that, prevents them from getting a loan?
Yeah, so good question. First look, if you told me, hey, I'm working with a partner, we're going to go 50-50 on this deal, we're both going to be GPs, or, we're both going to be, 50% owner. He's got 500 units, right? Immediately you tell me that, I'm not even thinking about sponsorship's going to be an issue at all. You come to me and you say, he's got 500 units, but they're all in Puerto Rico. He lives in Puerto Rico, and we're buying 1,000 units in upstate New York. Then we're going to evaluate that a little bit more. But back to your question, on a deal like that with sponsorship that already has 500 units, and assuming that it underwrites like a normal deal would, the one thing that might knock that deal out, which this is kind of top of mind because I just went through a similar, much smaller situation, but a similar situation, is if they've only owned those 500 units for 2 weeks.
Okay.
So I'm serious. I was just looking at a 100-unit deal, a 60-unit deal, and the owners already own like 29 units, the owners already own 19 units. And it turns out that they only bought them 2 weeks ago. So really they have zero management ownership experience as far as we're concerned. The general guideline is we want to see that you have owned properties, not just you, again, your team has owned and managed properties in the same kind of size range for more than 2 years. Not saying we can never get a deal done if you've owned property for less than 2 years. But that's kind of the general kind of metric where we start. So if you told me, okay, we've owned 500 units, we've owned them since 2017, and we're buying this property, 50 miles from where we live, I'm not going to have any issues with sponsorship.
Okay, great.
On
Thanks,
that.
David. Yeah, I appreciate it. Thanks, David.
Sure.
All right. So we're just at 8 o'clock, and I know I have one last question before we're going to let people jump off if they need to, and if you want to stay for a few extra minutes, David, Joseph and I always stay.
I'm more than happy to stay.
All right, but this question I think
Thanks, guys.
Thank you, Ryan. This question is going to be actionable for and provide people on this call with some value. What's a safe number to be like interest rate for underwriting for us, because we're all underwriting, and what should we, conservative, but also fairly realistic?
Yeah, that's a tough one. And the reason that's a tough one is because I don't know what type of deals you guys are doing. If you're doing deals that are 6 million or more, 10 million or more, the pricing is going to be very different than if you're doing a $1, $2, $3, $5 million deal. It also depends on what market you're in. A $20 million deal in Dallas is going to get different pricing than a $2 million deal in Oklahoma City or Longview or the southeast border or even Houston. So I think the important thing to note is just be aware of where your deal falls. Buying, if you and one of your buddies is going out and buying a $5 million deal, that may be a big deal to you. But in the scheme of pricing a loan that's going to then get securitized and have a large institution invest in it, it doesn't move the needle a whole lot as far as driving your pricing down. That said, even within, even in deals less than say $7.5 million, you're going to get better pricing on a $7 million deal than you are on a $4 or a $1.5 million deal. Thanks, Bobby.
Sorry, I gotta go, guys. I got another call.
Take it easy.
2 weeks. David, thank you very much. Good stuff.
Yeah. No, feel free to connect with me later on.
I will. My partner, James, get his stuff, James. Here's the phone. Thanks, guys. I gotta go. Sorry.
See ya.
We'll send his contact information on the follow-up email also.
Yeah. That'd be great. So that said, I priced out a $20 million deal in Dallas last week. Pricing is going to be between 2.8 and 3.1, 3.2, something like that. I also priced out, that was probably a 10-year fixed rate deal. Priced out a $3 million deal in somewhere. Anyway, $3 million deal priced out. It's going to be closer to say 3.6, maybe 3.5, 3.4. Variation can be a lot wider. If you want to do a 30-year fixed, you're probably still close to 4%. That's another thing to think about, what term you're looking for. Your 30-year, your 15-year is going to price wider than a 10-year, just because rates are quite low, and you're asking a bank or a lender to lock up the money at that interest rate for a much longer period of time. So depending on the deals you're going into, if you're going into kind of normal, kind of smaller deals between, let's just say between 1 million and 7.5 million, I would use, maybe if you want to be conservative, use 375. If you want to kind of push things a little bit more, but still have a rate that could very well shake out, use 3.5. If you're doing those larger deals in great markets, you want to price in 3.25 to be conservative, or 3% to be a little bit more aggressive. That's where I would be.
Are we doing any IO?
Yeah, it depends. I mean, again, it depends on the market. With Freddie Mac, their small balance program tiers the markets by size. So if you're in a small market, you might be able to get a year or two of IO. If you're in a normal market and you're doing a 10-year deal, you get 3 years. Fannie Mae, we're only delegated to get you 12 months of interest only. And if you're doing a small loan below $3 million, you're not getting anything more than that. If you're doing a larger $10 million deal or something like that, we can still go in and get you additional interest only. But if you're doing a refinance, you might not get any. If you're cashing out, that sort of thing. So, yeah, absolutely IO, but, it's very deal specific.
All right. Thank you. I think time is coming up, so we're going to wrap up. However, after this, we're going to still continue a little bit further of Q&A because I have a little more questions, if that's okay with David.
Fine by me.
All right. Where can people connect with you if they have a question, David? Can you give them your contact information?
Yeah. The easiest way, if you want to set up a call, is just shoot me an email. David.Frasz@Hunt Real Estate Capital. That's the easiest way if you want to just schedule something. If you want to just give me a call, 703-663-5886 is my office line. Feel free to give me a call anytime. I'm always happy to jump on the phone with people, get acquainted. I mean, again, this is a relationship business. This is important. Like I said, to build a relationship with the lender and feel comfortable that you trust them, that they're going to give it to you straight. There's no time for BS when you're trying to raise a few $1 million from investors. So feel free to give me a ring anytime. I'm always happy to take one-off questions. And then if we need more time, we can always schedule a longer call at some point. I'm pretty good with getting back to people. So just reach out anytime.
All right. Thank you very much, David. Today you dropped a lot of values, and especially today's meeting was smaller. However, everyone was in the game already, like I said, so everyone's question was very specific, and I'm sure everyone got little golden nuggets here and there. I'm going to introduce our next meetup topic as, let's see. So next meetup, we're going to have Adam Adams. He's a multifamily real estate investing guy. He's going to talk about his journey and how to utilize your social media platform like Meetup, podcast, and YouTube to boost your multifamily business or even other businesses. And he's a great marketing guy. So we're going to probably get another ton of value from him. Again, thank you very much, David, for today's time.
Absolutely.
We were honored to have you here.
Leo, I don't think we got to hear anything from you. Do you have any questions?
No, I think you answered everything, but some things come up late at night, like 5 o'clock in the morning, 4 o'clock. So I just copied your contact info.
Good.
He picks up at 5 in the morning.
Yeah, I'll probably get back to you around 6:30, but let's shoot it over at 5.
Yeah.
All right.
Yes,
thank you, David. Very valuable information. I appreciate it. Thank you.
Yeah.
Yeah, Dave, I really appreciate it, man. It's all this stuff, like when we're sitting here underwriting, it's like, I wish we had you right next to me, like a little angel on my shoulder,
Well, and that's one of the, I don't want to interrupt you too much, but that's one of the questions that you sent over to me previously. And, I think that's a good question. I get this all the time. When do we reach out to you? And really, it's never too early. I always say if you get to a point where you feel like you need a little extra comfort, you feel you need a little extra guidance, then that's when you reach out. It might just be a 10-minute call where you say, hey, I don't know if this works. And I say, oh, no, you're fine. Keep going. And that might get you another 2 weeks. But the reality is it's always better to reach out to your lender sooner than later. And frankly, like you said, you wish I was right there. I have clients that I was right there for a year and a half, where I basically every day I was on the phone with them talking through deals. And now I only get a call when they have one under contract, because they know I've taught them enough that they know exactly what they're looking for. And that's why I say, if you need a little extra comfort, that's when you get the lender involved.
Cool.
Great.
Man.
Great.
Great.
All right. I have a question. Actually, when Joe was asking about loan assumption, and I'm part of it too. So would you, let's say as a lender, right? Would you, if we do the loan assumption and the supplemental loan request at the same time, would you look at it as like favorable, non-favorable, or neutral? What do you think?
I mean, from a credit perspective, well, first, let me say that happens. That's very common to do both at the same time. But from a credit perspective, if you're not doing a supplemental, it means your loan to value is
Higher.
lower. And so, you may come into a deal, you're buying it, obviously at a premium from what the seller bought it at originally and financed it at. So unless they just did the first note recently, but if they've done if they put the loan on more than a couple of years ago, presumably you're buying it and you're getting, the loan is going to be, 65% loan to value instead of 80 or 75. So from that perspective, certainly it's less credit risk for us to just basically assign the loan to new sponsorship rather than to put more new equity, more new debt out, on the deal. But that, I mean, if you guys are strong enough from a sponsorship standpoint to support it, and the value comes in, the debt service coverage is where it needs to be, and the property's in good shape, then there's no reason we wouldn't do it.
Great. Thank you.
Is it one other thing? I'm sure you guys know this, but I wouldn't be doing my job if I didn't mention it. But obviously, an assumption has to be done with the lender who currently holds the note.
Right.
And the supplemental has to be done by that same lender as well. You can't get a supplemental you can't do an assumption that on a loan that I wrote and then get a supplemental from someone else.
Mm-hmm. Right. So how do I approach? Like, should I just mention that from the beginning? Like, we're trying to assume the loan and we want supplemental?
Yeah. I mean, presumably you've already, let's put it this way. If buying the deal without the supplemental makes your deal work for you and your investors, then it sounds like you probably get a pretty decent deal. And adding additional leverage via supplemental is going to be great for you. But yeah, I mean, just, you would, by that point, we would probably already hear from the seller that they're selling the deal. Mm-hmm. And most of the time they're the ones that are introducing the buyer, right? I mean, it's very rare that you would come to me and say, hey, I want a supplemental on this loan that you did last year. Mm-hmm. I would probably already be looped in somehow. We would know that it's being marketed in some way, or we might have already been asked for a term sheet. That's how it generally happens. Is the seller says, "Can you put a term sheet together that I can put out with our marketing package?" And so that's generally how we know.
I see. Thank you.
If he's going to do it as let's say joint venture or syndication, I guess I don't know if it really matters, but they don't have the credibility, they don't have the, they got the credit scores, but they don't have the net worth and liquidity. And let's say they just brought some guy in for net worth and liquidity reasons. How possible is it to get the deal done in that instance?
Well, I guess the distinction there is really, what do you mean by brought the guy in? If the guy's going to be a general partner and he's going to be a manager of the borrowing entity, 123 LLC, then he's part of the team, regardless of whether, you guys have done deals together in the past, regardless of whether, you guys individually are bringing, more than the $20 in your wallet. You know what I mean? I mean, at the end of the day, he's part of the team. If he's just a key principal, if he's just kind of someone who is signing on to the note, but not, not having any control over the entity, that's a different story. So that's good to help get the net worth where it needs to be, but that doesn't help on the experience front. If he's not able to control the entity, if he's not going to be directly helping out with the property, at least on paper, then it's not the same thing.
It's called like a key partners, right? That's
yeah. It's a Fannie term. It's called a key principal. Basically, someone who's being underwritten, someone who's signing docs, but they may or may not be actually a GP. They may not have any management or authority over the operations of the property, which is really what when we're looking at experience, that's what we're looking for. We're looking at people who have experience operating properties, right? So like you may own 1,000 units, but if you're a limited partner in 1,000 units and you come to us and want to do a 100-unit property, it's not the same thing. It's good. Clearly you've been in, working with real estate investors and you know what you're getting into, but it's not the same thing as actually signing on the dotted line and managing 1,000 units.
Oh, that brings me to ask another interesting question, I think. So let's say there's someone who owns 500 as a GP.
Yep.
But sometimes they like, or 1,000 units, they might got into the GP portion as an equity raiser, right? And maybe technically they were supposed to be part of the management, but let's say he was kind of equity raising guy and remained in that role pretty much. And it's still GP of 1,000 units. Would you be able to tell the difference in terms of the management experience? Okay, so if you see,
because they're a GP of 1,000 units.
Okay, cool.
Right. They're institutional investors that go in, and the CFO may sign. The CFO of the investor of the company may sign the loan, but he's not the one who's going to the property once a week.
Right.
His analysts or his, management professionals are going to the property. You know what I mean? But if you're a GP, there's no real way for us to know that. And that's why I made the distinction between a GP and someone, as Nico put it, that they're just bringing into the deal. Again, bringing someone on as a key principal helps with the net worth numbers, the financial part of it, but it doesn't help with the management part of it, because that all tracks back to basically the operating agreement and who has control.
Right.
Awesome, man. Thank you. Great advice, man. This is just Leo. Go for it. You have a question?
No.
Just listening. Cool, man.
Everything is covered so far.
All right.
Like I said, I'm probably gonna think of something, but I reached out to him. I reached out to Dave.
All right. I have no more questions. Thank you very much, David. It was
Absolutely. If
Thank you, David.
feel free when you shoot an email over, if anyone else has other questions, they can either send them to me, reach out directly. Like I said, always happy to chat and build relationships. Or if you guys want to take them in and aggregate them, I'm happy to try to get back to you guys with some bullet points.
Yeah, I'm going to provide an email with your contacts. Everybody can just click on a button and reach you that way.
Cool.
Yeah.
Cool. I appreciate you guys having me on. This has been great. And I think everyone had good questions. So I just hope I was able to answer them all.
Absolutely, man.
Absolutely,
Thank you, David.
man.
Thank you, David.
Thank you. Thank you, David. All right.
Yeah.
Thank you, Leo.
All right.
Thanks, guys. Oh, James, good night to you too, man.
James.
Thank you.
Good night, guys.
Thanks, guys. I appreciate it.
All right. Good night.
Bye-bye.